Silicon Valley leadership is being remarkably blunt about the near future of white-collar work. Anthropic CEO Dario Amodei publicly predicted that artificial intelligence will disrupt 50% of entry-level office jobs over the next 1 to 5 years. Those predictions currently lack support in the macroeconomic data. While executives forecast massive displacement, the overall U.S. unemployment rate remains steady at roughly 4%. This creates a distinct cognitive dissonance for knowledge workers trying to navigate the current economy. Professionals see AI models generating code, marketing campaigns, and financial audits in seconds, but they aren't seeing the corresponding lines at the unemployment office. The disruption is happening, but it is quiet and systemic. Looking for mass layoffs means looking at the wrong metric entirely. The AI labor market is defined by a big freeze in hiring. Companies are transitioning from basic task assistance to complete workflow automation, where machines execute entire processes end-to-end. By automating these processes, businesses are choking off the intake valve at the bottom of the organization. This quiet constriction is also exerting a powerful counterintuitive force on global interest rates and macroeconomics. Understanding the AI transition requires looking past the mass layoff fear and examining what is actually happening at the bottom of the org chart. This chart from the Bureau of Labor Statistics proves the disruption is concentrated at the bottom. The unemployment rate for college graduates between ages 20 and 24 is spiking sharply, even as the broader 16-plus unemployment line remains mostly flat. Research from the New York Federal Reserve indicates that recent graduates in computer science and engineering are currently struggling more to find jobs than those with humanities degrees. This is the result of a specific corporate mechanic. Businesses are freezing entry-level backfills rather than laying off current experienced staff. In a typical year, a company experiences a 13% natural turnover rate. Instead of posting job requisitions to replace those who leave, management simply lets the headcount shrink. They then use AI to extract the missing output from the remaining employees. The big freeze hides job destruction by turning it into a lack of opportunity for new workers rather than a loss for current ones. The technology driving the freeze is the leap from generative AI to agentic AI. Generative AI is a tool for discrete task assistance, like drafting emails, requiring a human driver for every step. Agentic AI systems absorb multi-step workflows end-to-end, revising their own approach with minimal human input. In the accounting sector, platforms like KPMG's Clara or Dual Entry are executing zero-entry bookkeeping. These systems review 100% of audit transactions, eliminating the manual drudgery work that previously required armies of junior analysts. In logistics, firms like C.H. Robinson are handling 29% more volume with 30% fewer employees than they had in 2019. In marketing, programmatic ad buying and automated segmentation are absorbing the traditional roles of media planners and copywriters. Agentic AI systems isolate human workers strictly to nodes of judgment and final approval, rendering pure execution roles entirely obsolete. This micro-level shift has macro-level consequences, specifically regarding the assumption AI will drive interest rates lower. Automation drives massive labor productivity, which lowers unit costs and acts as a powerful disinflationary force. However, that efficiency is countered by the unprecedented infrastructure cost required to sustain these systems. Major tech companies are projected to spend over $600 billion annually on AI capital expenditures through 2030. This massive spend on physical infrastructure, power, and chips is inherently inflationary. When combined, disinflationary labor efficiency and inflationary infrastructure spend yield stronger real GDP growth and higher real interest rates. The assumption that AI leads to lower interest rates is unsupported by the data, which actually points to a higher neutral interest rate. The big freeze creates a secondary crisis for human capital development. Yale Insights identified a critical risk here: the systematic destruction of the entry-level training ground. If agentic systems handle all the entry-level execution, junior workers lose the opportunity to get the reps required to learn the business. Senior-level domain knowledge and strategic judgment are earned through executing the very tasks that AI is currently automating away. Companies are trading their future leadership pipeline for short-term productivity gains. For the individual professional, the rules of the AI economy have changed. The value of human capital has shifted away from task execution, basic data processing, and first draft generation. High-premium skills now include skepticism, validation, complex problem-solving, and strategic oversight. Professionals must now manage and verify machine outcomes rather than focusing on manual task completion. The economy is not running out of work, and mass layoffs are not the immediate structural threat. The entry ramp into the knowledge economy is narrowing, forcing a survival strategy